What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the channel. In this week's video, it's going to be a little bit different style of a video. I'm instead going to go over a very common question people have when it comes to exchange-traded funds, and that is whether or not they should be buying a US-listed S&P 500 ETF or whether they should look to Canadian ETFs like ZSB, like VFV, instead of VOO. So in this video, I'm going to go over the differences between the two, how hedging and non-hedging comes into play, and most importantly, the specific tax rules when it comes to buying Canadian domiciled ETFs that have underlying US holdings, because you may not understand how exactly this works even in an RRSP. So with that being said, let's dive right into the video. So as always, before we get started, head down below to the description. You can join the No BS newsletter. It is our newsletter over at Stocktrades. We're sending out stock picks, market commentary, insights, case studies, strategies, all that type of stuff 2 times a week, absolutely free, no gimmicks. On Thursdays, you can catch me on the Canadian Investor Podcast with Simone. And if you want to see my full portfolio, our model portfolios, all of our research, our screeners, everything you can imagine, our private Discord, you can join Stocktrades Premium. It is available on our website. I'll throw a link in the description for that too. So VFV would be one of the most popular S&P 500 ETFs here in Canada, but I'm going to tell you that it is probably not optimal from a taxation perspective, and you might hold it in an RRSP and not even understand that you are getting charged a withholding tax on this fund. And I'll explain why that is the case in a little bit, but first, I just want to go over, for some of you that may not know what the S&P 500 is, and I also want to go over the returns relative to the TSX, because I believe a lot of Canadians are way too hyper-focused on Canada, mostly because they structure their portfolio to generate dividends at the expense of total returns, possibly, when in reality, a lot of people should be focused on total returns. They should be focused on diversifying internationally, because although Canada is one of the top 10 countries in the world in terms of GDP, we make up a very small portion of global GDP. And if you have a huge chunk of your portfolio invested in Canada, you're probably not maximizing the total return potential of your portfolio. Now, that's not to say that you can't own Canadian stocks, a bunch of Canadian stocks. The vast majority of my portfolio is Canadian stocks. I believe 60%, maybe a tad less than that. But the thing is a lot of the Canadian stocks that I own, most of them are not focused in Canada. They have international operations, and actually for most of them, very little of their revenue comes from Canada. But anyways, kind of rambling on there, let's get back to the S&P 500. So when we look to the S&P 500 returns here, which is the 500 largest companies in the United States, it often hovers, anywhere from 500 to 510. But this is an index that is much like the TSX 60. We don't have enough strong companies in Canada. We don't have enough large companies in Canada to ever have a TSX 500, something like that. So we have the TSX 60. That would be a very similar index here, where we're tracking the 60 largest companies in Canada, but the US is big enough they can track the 500 largest. So we're looking at returns since this looks like the late 80s. Y-Charts has it tracked of 2.91K. So if you look to this in annualized numbers, you're looking at an annualized return of around 10.36%. Now, a lot of people say that the markets will return anywhere from 10 to 12%. I would say 10% on the high end. If you see people that are talking about measuring the markets based on a 12% annualized return, that's just silly. It just doesn't happen that often. If we were to look to growth of $10,000, if you were to invest $10,000 in the late 80s in the S&P 500 and you wouldn't touch this thing, it would be worth $300,000 today. That is absolutely absurd. The returns on this index, due to the just sheer growth of the United States, has been phenomenal. Now, when we add the TSX into this, it really has struggled. Now, on a overall return basis, it's up 1,260%. That's not that bad. But when you're looking at a 7.86 annualized return versus a 10.36 annualized return, that is a huge difference. And you'll see this in the growth of $10,000. So we're looking at $300,000 in the US versus $136,000 investing in Canada. Now, some people might be happy with that $136,000 return, which, by the way, is dividends reinvested. But ultimately, if you're hyper-focused on Canada, you're probably not going to get as large of returns as if you were to invest in the S&P 500 or the global markets. Now, why is that? Well, for the most part, Canadian stocks, a lot of them are what they would call old economy stocks. We've got the railroads, which, don't get me wrong, I own them. They are outstanding performers. Pipelines, we can think oil and gas companies. Whereas the United States, and specifically the S&P 500 as of late, has had a lot of those tech options. The Magnificent Seven. We've got Google. We've got Tesla. Not so much anymore. Tesla's really struggled over the last while. But we got NVIDIA. We got Amazon. We got Microsoft, Apple, all those types of companies. Those, they would call new economy stocks, have driven a lot of the growth moving forward. And ultimately, we can probably expect that to continue moving forward. Now, I'll show you a quick example of what I mean by this. If we go to XIU, which is the iShares S&P TSX 60 ETF, and I scroll down here to the growth estimates. So, forecasted 5-year earnings growth for the TSX 60 is around, the holdings inside this fund, which is the TSX 60. It's estimated to grow at 6% a year and 8% revenue growth. When we look to a fund like VOO, we can see that forecasted 5-year earnings growth 11% with revenue growth of around 8.75%. So forecasted next year's earnings growth of 14%, whereas XIU is negative. They actually expect negative earnings for most of the TSX 60 moving forward over the next year. It's because a ton of these stocks are cyclical. A ton of them are sensitive to interest rates. I mean, we have the banks up here, the railroads, the pipelines. You can see, Brookfield, financial asset managers. This is a very interest rate sensitive index. So it's not particularly the case in the S&P 500, and that is why they expect much more growth moving forward. So regardless of your overall strategy, obviously I can't tell you what to do. You have to figure that out on your own, but I just wanted to make this video because there's a ton of investors, when they show me their portfolios, it's like 85% Canadian blue chip dividend payers, and they just have very, very little exposure outside of Canada, very home country bias. So that's all I'm going to say about that. Now, I want to talk about, if you're looking to buy an S&P 500 ETF, if you should look to something like VFV or if you should look to something like VOO. Now, the one thing that is very similar with these funds in terms of Canadian listed S&P 500 funds, when we look to VFV or when we look to ZSP, they are virtually the same. They have the same management fee. They have very similar dividend yields. You're talking like 5 or 6 basis points different. And in terms of total returns, we can see compared to VOO, this deviance in VOO, which would be the bottom fund here, the 229% versus these funds up top, it's just currency exchange. So this is obviously a fund that trades in US dollars. So that is why it looks like a large outperformance here, but in reality, it's just due to a weakening Canadian dollar. But when you look at ZSB versus VFV, the difference over the last 10 years is 0.5%. It's not even worth thinking about. Whether or not you choose to buy one of these funds is completely up to you. Maybe you like BMO more, you like Vanguard more. It doesn't really matter. Assets under management, you're talking 12.45 for VFV and 16.01 for ZSP. But the main issue here is a lot of Canadians don't want to convert their money to US dollars. Now, whether that's because you don't want to pay the 1.5% fee at your brokerage, or you just don't like the idea of owning less money, I'm not sure. Or maybe you're spending most of your retirement money in Canada, so you don't necessarily want to convert to US dollars. Regardless, a lot of people are holding these Canadian domiciled funds, which even in an RRSP, you will be subject to withholding tax. So I made this chart here that I hope will help people. And it's just on my Canva here. I didn't actually download the chart, but it will show you how you can structure your account and how you're going to be exposed to different types of taxes. So we have a tax treaty here in Canada and the United States. They recognize the RRSP as tax sheltered retirement accounts that you can save on withholding tax. They don't recognize the TFSA, and that's why a lot of people like to hold US paying dividend stocks and just US stocks period in their RRSP. But the thing is, a lot of them are holding VFV, and you will be charged a withholding tax even if you hold this. And the reason for this is if you hold a Canadian listed ETF holding a US listed ETF holding US stocks. I know this sounds brutally confusing because they make it confusing. So if you hold a Canadian listed ETF that has a US listed ETF, you will be charged withholding tax even in an RRSP. If you own a Canadian listed ETF that holds US stocks directly, not necessarily a US ETF, you will be charged withholding tax even in an RRSP. So what does VFV hold? Well, VFV is a Canadian domiciled fund, and if we go to the holdings here, it just holds VOO, just VOO. So if you hold this in an RRSP, you will be charged withholding tax. If you own VOO, you will not be charged withholding tax. Now, this is a relatively small amount of money. It's a withholding tax on the distribution. It is a very tiny distribution. So this is not necessarily a game changer for a lot of people. However, if you want to mitigate taxes to the maximum extent, if we put aside all currency risk, all, whether or not you want to own US dollars or not, because ultimately I can't make any of those decisions for you. You have to do it yourself. Owning VOO is going to be better inside of an RRSP from a tax perspective. You will not get charged withholding tax if you own VOO, whereas if you own ZSP, which ZSP, if we go to the holdings, individually holds US stocks. So if we go back to this chart, if you own a Canadian listed ETF holding US stocks directly in an RRSP or an RRIF, you will be charged withholding tax. In a TFSA, RDSP, RESP, you will be charged withholding tax. And in taxable accounts, you will also be charged withholding tax. The only difference is in a taxable account, you will be able to recover some of those taxes via the foreign tax credit. So what do you own inside an RRSP that is not charged withholding tax? Well, I mentioned that. It is VOO in terms of S&P 500 ETFs. US ETF holding US stocks. Inside an RRSP, you will not be charged withholding tax. So I hope this chart makes sense. If you want me to explain it a little bit more, again, just go down to the comments and let me know. I'll do my best to kind of explain it even further. Do I believe that every investor should have exposure to the United States? Yes, whether or not you believe that the US markets are overvalued and they're set to underperform over the next while, that's completely up to you. I truly believe that, most all investors need to have some form of US exposure. And I've noticed a lot of Canadian investors, I've been doing this for 6 or 8 years. They're way, way too exposed to the Canadian markets. And they do this because it's a currency they know, because it's companies they know. They feel comfortable doing it. They don't necessarily like buying more expensive stocks on a price to earnings basis relative to the US markets. But what a lot of them don't understand is the US markets have historically, nothing's guaranteed in the future, but historically they have grown at a much faster pace than the Canadian markets. And as such, they're going to be more expensive. Now, if you're looking to buy the S&P 500, but you are really dead set on the Magnificent Seven being way too overvalued, you don't want exposure to them, heavy exposure, because if we do look to the constituents of the S&P 500, we can see that big tech makes up a big chunk of them. I mean, you're looking at, we've got 7, 6, 13, 18, 21, 23. You're looking at a quarter of this index. And actually, if we go here, 27 some, you're looking at, 27% of the S&P 500 being allocated just to big tech. So you might not like that. And if you don't like that, you could always look towards an equal weight option. So if we go to an S&P 500 equal weight, such as RRSP, which, it's a big fund, 51 billion in NAV. It's got an expense ratio of 0.2, so it's a little more expensive. But if we go to the holdings, it equal weights all of the S&P 500. So this fund historically performed pretty decent relative to the S&P 500 until big tech came around. I mean, if we look to, say, RSP versus SPY, let's go total return over the last, particular amount of time, we can see that SPY really took off post-pandemic. But if we go to max returns, the equal weight S&P 500 fund actually outperformed SPY for quite some time. And if we factor in all returns, if we go back to early 2000s, it's still outperforming SPY. But ultimately, that was because of returns in the past and not necessarily returns now. It's struggled as of the last 10 years, particularly, the last 5 years, 3 years. But it's an option in terms of S&P 500 exposure if you want it. RRSP is probably one of the most popular ones. So that's an option if you're looking to go equal weight. So that's pretty much it for this video. I just wanted to go over, some intricacies when it comes to, the Canadian listed funds and the US listed funds, whether or not you want to go equal weight, just the historical performance of the S&P 500 relative to the TSX index, and how, you should maybe sit down, look at your portfolio, see how much exposure you have to Canada, see how much exposure you have outside of Canada. The projected growth of the Canadian economy is not good. And as a result, if it comes to fruition and the Canadian economy does struggle, those who have heavy exposure to Canada, their portfolios really might suffer. I mean, we've witnessed strong growth in the U.S. economy, even at some pretty sky-high interest rates, whereas Canada is really struggling. So it's put Canada in a position where, they might have to cut rates, whereas the U.S. economy seems to be going along quite fine, and it might cause the Fed to maintain rates. And this creates a whole other element of struggles if Canada is forced to cut, while the U.S. can stay afloat at current rates. It can drive a lot of inflation due to a devalued currency, and it can just, it can create not a very good situation. So I do believe that you should be investing your assets across a wide variety of geographical exposures, whether it be international markets, US markets, Canadian markets, and ultimately, I hope this video helps you if you're looking to get exposure to the S&P 500, but you don't quite know what fund to buy. Again, head down below to the description. You can find our No BS newsletter. Sign up for it. It's 2 times a week. You're going to get content like this, even better content like this. You're going to get case studies, stock picks, research, market insights, all that type of stuff. Head down below 2 times a week. It's completely free. And Simone on the Canadian Investor Podcast. Every Thursday, we're doing earnings reports on Canadian and U.S. companies. They're great conversations. It's a great podcast. So head over there, subscribe to it, listen to it, and I'll see you next time with more great video content.